Welcome back to Talk Tickers, everybody. Ready to jump into some earnings?
Always, let's do it.
All right, today we're diving into Capital One's Q4 2024 earnings call. They're obviously a huge player in the credit card world and consumer banking overall. So their numbers can really give us a peek into what's going on with the average consumer right now, especially with that Discover acquisition still on the table.
Yeah, it's going to be interesting to see how that plays out. Their data-driven approach has always kind of made them stand out in the industry. So I think what we learn here can tell us a lot, not just about consumer health, but maybe even the bigger economic picture.
Okay, so let's hit those big headline numbers first. Capital One earned $1.1 billion, or $2.67 per share for the quarter.
Not bad.
And zooming out to the full year, they pulled in $4.8 billion, which works out to $11.59 per share. Looks pretty good from the outside.
Definitely solid numbers, but like always, we got to dig a little deeper, right? When you adjust for some things like integration costs from the Discover deal and a legal reserve they had to set aside, those earnings per share actually shift a bit. So you're looking at $3.09 for the quarter and a very healthy $13.96 for the full year.
Got it. So earnings are looking up, but revenue growth was a little less exciting, up just 2% this quarter. And what's really interesting is that most of that increase came from non-interest income, not their main lending business.
Okay.
Plus, Capital One set aside a hefty $2.6 billion for potential credit losses, which is about $160 million more than last quarter. This has got to raise some eyebrows, right?
Yeah, definitely. Part of that increase was due to actual charge-offs, meaning loans they basically consider uncollectible.
Right.
But there's another piece to this puzzle. They also released a bigger chunk of their allowance for credit losses this quarter.
So what does that mean?
Well, it suggests they might be feeling a bit more optimistic about credit performance going forward, even with those charge-offs.
So some mixed signals on the credit front then. Let's unpack that a bit more. Starting with delinquencies, Capital One reported that delinquencies are finally down year over year, which seems like a good sign after all the ups and downs we've seen in the credit markets lately.
It is positive, for sure, but the question is, what's driving it? Is it a sign that consumer finances are genuinely improving, or are there other things at play?
Like what?
Well, think about it. Government stimulus programs have pretty much wound down, which could be putting some borrowers in a tighter spot.
True. It's not like everyone's suddenly flush with cash.
Exactly. And Capital One themselves mentioned this minimum payment effect they're seeing, even among customers with good credit scores.
More people choosing to pay just the minimum on their cards. What does that tell us?
It could be a sign that people are feeling a bit squeezed, even if they're not officially delinquent yet. They might be stretching their budgets thinner and being more cautious about spending.
Makes sense. Now, we should probably keep in mind that Capital One does have a larger share of subprime borrowers compared to other banks. And their credit performance can be a bit more volatile, especially around tax refund season.
Always good to remember those nuances.
Yeah.
Yeah, investors definitely need to consider the whole picture.
All right, so let's switch gears a bit and talk about Capital One's auto lending business. They've actually seen some pretty solid growth there with originations up for the fourth quarter in a row.
Wow, 4 quarters straight. That's impressive.
Right. Seems like a bold move considering interest rates are going up and there's some chatter about vehicle values. What's their secret sauce?
Well, Capital One's been talking a lot about their disciplined approach to underwriting and their investments in technology to help them manage risk.
So they're being picky about who they lend to.
Exactly. It seems like they believe they can navigate the auto market by being very selective and using data to price those loans just right. It's a strategy worth watching for sure.
Yeah. Especially because their auto delinquencies are actually lower than they were pre-pandemic, which is pretty remarkable given all the economic turmoil we've been through.
No kidding. It's a testament to how effective risk management can make a real difference, even in unpredictable times.
Speaking of adapting, let's talk about the big one, the Discover acquisition. Still on track to close early next year, as long as the regulators give it the green light. This deal has the potential to be massive, creating a consumer banking and payments powerhouse with over 100 million customers. What do you think are the key factors that will make or break this merger?
Oh, that's a big question. Integration is definitely key, right? Bringing together two huge companies, each with their own systems, their own way of doing things, their own customer base. It's a huge task. Capital One's got to be really careful to make sure things go smoothly for both Discover and their existing operations.
It's more than just keeping the lights on, though, right? It's about making sure those potential synergies actually materialize. Capital One keeps talking about building the bank of the future, one that combines the ease of digital banking with a more streamlined physical presence, like their cafe concept. think they can fit Discover into that vision?
That's a tough one. Discover's really focused on the prime consumer segment, which hasn't really been Capital One's sweet spot historically. So how do they cater to both prime and subprime customers without messing up their brand or sending mixed messages? That's the strategic challenge right there. That's what will determine whether this deal actually creates value.
Good point. And then there's the international piece. Capital One's planning to put a lot of money into expanding Discover's network and brand building, especially overseas. Sounds like they see this as a way to go global, not just consolidate in the U.S.
Definitely, international growth could be a major driver for them. But it also makes the whole integration process way more complicated. Navigating regulations, cultural differences, competition in different markets, that's no small feat.
It'll be really interesting to see how the competitive landscape shifts because of this deal, too. Will other big players in banking and payments feel like they need to make their own acquisitions or team up to keep up?
Yeah. Who knows? Maybe. We'll have to see how it all shakes out.
One thing's for sure, though. This is a shakeup. Capital One's making a big bet on the future of banking. And it'll be fascinating to watch whether their vision actually becomes reality.
Absolutely.
So before the break, we were getting into Capital One's whole data-driven approach and how it could be their secret weapon as they bring Discover into the fold. I'm really curious, what are some concrete ways they're using data and tech that really stand out to you?
Well, one area where they've been ahead of the curve is using machine learning to figure out credit risk.
Oh, yeah, I've heard about that.
They've basically built these algorithms that can crunch massive amounts of data to get a much more detailed picture of a borrower's financial health. It goes way beyond those old school credit scores.
So not just about your FICO score anymore.
Yeah.
What kind of data are we even talking about?
It's pretty broad. They're looking at things like your spending habits, how steady your income is, even your social media activity in some cases.
Whoa, really? Social media too?
Yeah, it's all about building a more complete profile so they can predict whether someone's likely to repay their loans.
That's kind of amazing. And also a little creepy, if I'm being honest. It raises some serious privacy flags, doesn't it? How do they make sure they're respecting consumer privacy with all this data gathering?
It's a tightrope walk for sure. They have to be super transparent about how they use customer data and make sure they're following all the rules. And they've also invested heavily in cybersecurity to make sure that data stays safe from breaches.
Makes sense. But this whole data thing isn't just about credit decisions, is it?
Not at all.
Yeah.
They use it for all sorts of things, like personalizing their marketing campaigns so they can target specific offers to people who are actually likely to be interested.
Smart.
Right? And they even use data to improve the design and layout of their website and mobile app, trying to make them as user-friendly as possible.
It's wild how much data shapes our experience as consumers, even when we don't realize it. All right, let's switch gears for a second and talk about some of the risks Capital One's facing. The economy is not exactly booming right now, and there's always that chance of another recession. How are they positioned to handle a downturn?
Well, one of their strengths is that they're pretty diversified. They're not just a credit card company. They've got a big presence in auto lending, like we talked about, plus commercial banking and those basic savings and checking accounts. Spreading the risk is always smart.
True. But even with that spread, a bad recession could still hit their credit card business pretty hard. And that's still their core business, right?
Of course. No bank is totally immune to a major economic crash. But Capital One's done a decent job of strengthening their balance sheet and building up their capital reserves. So they've got some cushion to absorb potential losses. And they've also started tightening up their credit standards in certain areas, like auto lending, where they're seeing some early warning signs.
So they're being cautious. Makes sense. But doesn't that make it harder for them to grow if they're pulling back on lending?
It's a balancing act for sure. They got to find that sweet spot between growth and risk management. But don't forget, they're still going after growth opportunities, especially with that Discover acquisition. That deal could really boost their scale and market share even if the economy is struggling.
Speaking of that acquisition, what are some of the biggest hurdles they'll face trying to integrate Discover? It can't be easy merging two giant companies like that.
Yeah, it's a massive undertaking. You always worry about culture clash when you merge companies. Capital One and Discover have totally different histories, ways of doing business, even different employee demographics. Bringing those cultures together without a ton of friction, that's going to be key.
It's not just the people, though, right? You've also got all the technical challenges of merging their systems and processes.
Oh, absolutely. It's a logistical nightmare. They'll have to figure out how to combine different IT platforms, data management systems, even customer service protocols. It's complicated and it takes time, and there's always a risk of things going wrong along the way.
And on top of all that, they're dealing with a regulatory landscape that's changing all the time. Fintech is evolving so rapidly, and regulators are still trying to figure out how to oversee this whole new world of digital finance.
Right. It's a lot of uncertainty. How are new regulations going to impact Capital One's business model? Especially as they get deeper into things like machine learning and data analytics. They need to stay agile if they want to stay ahead of the curve.
Sounds like they've got a lot on their plate. But it's an exciting time for them, too. They're really pushing the boundaries of innovation in the banking world, and the Discover deal gives them even more power to shape the future of finance.
I agree. It's a risky move for sure, but it could be transformative if they pull it off. They've got a real chance to create something special, but there are some big obstacles in their way.
Well, listeners, we've covered a ton of ground today, from credit trends and auto loans to the ins and outs of the Discover acquisition. We've looked at Capital One's strengths, their potential weaknesses, and all the opportunities and risks ahead. But before we wrap up, it's time for our favorite part. The part where we throw caution to the wind and brainstorm some outrageous but plausible trade ideas.
Oh, yeah, this is the fun part. Just remember, folks, this is not financial advice. We're just having a little fun exploring some possibilities.
Yeah.
So if you're feeling adventurous and you've got a high tolerance for risk,
Lay it on us. What's the big idea?
all right, here's what I'm thinking. What if you shorted a basket of those old school bank stocks? You know, the ones that are still super reliant on physical branches and haven't really embraced the digital world?
Whoa. Okay, that's a
Dude.
bold move.
Sure.
But I like it. Tell me more. Why are you so down on traditional banks? Wouldn't the fact that interest rates are rising actually help them, at least in the short term?
Maybe. They might get a little bump in profits from higher rates. But I'm playing the long game here. I think this whole shift toward digital banking is going to chip away at their traditional advantages. Consumers, especially younger folks, they want a smooth digital experience, personalized services, transparent pricing. Traditional banks just aren't built for that world.
Yeah, it's like they're trying to fit a square peg in a round hole.
Exactly. And that's where I think Capital One has a real advantage. They're not afraid to shake things up and embrace technology, even if it means disrupting their own traditional ways of doing business.
So they're kind of like the exception that proves the rule.
Yeah, I think that's a good way to put it. They're not perfect by any means, but they're at least asking the right questions and experimenting with new approaches.
So to sum up your trade ideas, basically betting on the disruptors like Capital One and against those legacy banks that are slow to adapt.
That's it in a nutshell. It's definitely high risk, high reward. But if you believe, like I do, that the future of banking is digital, well, it might be a bet worth taking.
All right, listeners. Once again, this is not financial advice, just some fun speculation. Always do your own research before making any investment decisions.
Right. Don't blame us if it goes south.
Exactly.
Yeah.
All right, so let's zoom out a little bit. We've covered a ton of ground today with Capital One, from those credit trends and their auto lending strategy to the massive potential shakeup from the Discover acquisition. It's clear they're a company to watch.
Absolutely. Their moves often signal bigger shifts happening in the financial world. So even if you don't bank with Capital One, their story gives you some valuable clues about where the whole industry is headed.
Definitely. Before we wrap up, I always like to get your big picture takeaway. What's the one thing you really hope our listeners will think about after this episode?
Good question. I think what's most fascinating here is how Capital One's journey shows us this bigger trend. The way data and technology are becoming more and more intertwined in the financial world, they've basically built their whole business model around using data to make better decisions about credit risk, about marketing, about customer experience, even their physical branch strategy.
And they've been so quick to adopt cutting-edge technologies like cloud computing and machine learning. They're always pushing the envelope in banking.
For sure. So the question that keeps coming back to me is, how is this data-driven, tech-focused approach going to change the way we bank over the next 5 to 10 years?
Now, that's the big question, right? Will we see even more personalized financial products? Will we have AI-powered financial advisors helping us make smarter choices? Will those traditional bank branches become a thing of the past, replaced by sleek digital hubs and maybe those Capital One cafes?
Those are just a few of the possibilities. And of course, anytime you have these technological leaps, there are ethical concerns and potential downsides to consider too.
Right, like those privacy issues we touched on
Yeah.
earlier. How do we make sure all this data is being used responsibly and ethically? It's a crucial conversation to keep having as these technologies get more and more advanced.
Couldn't agree more. This episode is just the beginning. Keep exploring these themes. Keep watching Capital One and their competitors and the whole fintech scene. The future of banking is being shaped right now, and it's an exciting time to be paying attention.
Well said. That's a perfect note to end on. Thanks for joining us on Talk Tickers, everyone. We hope you found this deep dive into Capital One's earnings call informative and thought-provoking.
And maybe a little bit entertaining, too.
Of course. If you enjoyed the show, please subscribe and leave us a review wherever you get your podcasts. It helps other listeners find us.
And don't be shy about sharing your thoughts and questions on social media. We love hearing from our listeners.
Until next time, happy investing, everyone.